My name is Rob Bruff. I'm the Executive Vice President of Marketing and Communications for Zions Bank, and it's my privilege now to introduce Robert Spendlove. Robert is the Senior Economist for Zions Bank, and he monitors and reports on economic indicators and public policy developments for Zions Bank. His annual economic forecast is always insightful, and we look forward to Robert sharing with us his insights today. And so, Robert, we will now turn the time to you to share with us your 2023 economic outlook.
Great. Thanks, Rob. Appreciate it. Can everyone hear me okay in the back? Okay, good. And I'm going to apologize right now. I've got a little bit of a dry cough, and so I'm just kind of working through that. So there's something I've been doing for the last few months, and I wanted to do it with this group too. So the big question right now in the economy is, what's happening with regard to recessions, right? So there's all this debate about if we're in a recession, if we're going into a recession. Oh, sorry, they want me to switch over. Okay, let me turn this off, right? Is that what you're telling me to do? Okay, we're getting some feedback. How about now? Hear me now? How's that? Okay, so I'm going to survey you, and you tell me what you think. There's 3 scenarios. Scenario number 1 is that the economy today, as we sit here, is in a recession. Scenario number 2 is that we're not in a recession, but one is coming in the next 12 months. Scenario number 3 is that the economy is slowing, but we'll be able to avoid a recession. Okay, so I want each of you to vote. You can only vote once and only vote with one hand. Okay, votes for number 1. Okay, votes for number 2. Okay, and any optimists, number 3. Oh, wow, that's great. So what I got was about 25% for number 1, about 50% for number 2, and 25% for number 3. Does that sound about right? For those of you at the back watching, this has changed. And why does this matter? Because each of you and your interactions in the economy have a big impact on whether this is going to happen. But here's the problem. We don't know. We don't know who's right. One of you will be right. But, well, maybe a few of you, right? One of these scenarios is correct, but we just don't know which one. So if you look at like the top economist really in the world is Jerome Powell. Jerome Powell is the chair of the Federal Reserve. He's the person who runs the Federal Open Market Committee. The Fed sets interest rates. The Fed really guides the economy. So what does Jerome Powell say about this very question? No one knows whether there's going to be a recession and how bad that recession will be if we have it. Jerome Powell, this was about 3 weeks ago, said this. No one knows. So anyone that tells you that they know, be really careful, because none of us know if there's going to be a recession, and none of us know how bad it will be. And that really is kind of the theme right now of the economy, is this great level of uncertainty. We're in a historic period in the economy, and we continue to see trends that we weren't expecting, and we continue to see impacts that are truly historic. A lot of that is because of the pandemic. We like to think that the pandemic is ending, but the economic impacts continue, and the distortions that we've seen from the pandemic continue, and you'll see that throughout the presentation. So what are some of those indicators? Well, if you voted for number 2, this is your chart. So, and I'm not going to get into the technicalities, but this is what we call the yield curve. And the yield curve is just looking at the return on investment of different maturities of bonds. So on the far left, you've got very short term, 1 month. And on the far right, you've got very long term, 30 years. So if you think about it, as the time horizon increases, as you have to hold on to this bond for longer, that interest rate should go up, because there's the risk of holding on to it for a longer period. And so the line on the bottom is the traditional yield curve, and it should be upward sloping. As your time horizon goes further out, those interest rates go up. Well, look at the one on the top. This is the one right now. This is what we call an inverted yield curve. So you get a higher return on your investment for a 10-year bond, or excuse me, a 2-year bond than on a 10-year bond. And that is like the traditional indicator that a recession may be on the way. Essentially what it's saying is that the markets are broken, right? In fact, this has become so inverted. It's been inverted for about 6 months. But if you look at this inversion, it's gone all the way down. 1-month bond now has a higher interest rate than a 10-year bond. So you get a better return on your investment holding on to something for 1 month than on 10 years. And it's just an indication that the bond market is seeing more trouble on the horizon. Now, there's more reason for that than that. And essentially what it is, if you bifurcate this chart, kind of divided into 2 halves, the right side is overwhelmingly controlled by markets, while the left side is controlled by the Fed. So if you think about it, a year ago, the Fed, the interest rates controlled by the Fed directly were very low. The Fed's been pushing those rates up for the last year, and that's caused that inversion in the yield curve. So let's look at that. So the Fed really only controls one rate, and that's the rate I'm showing you. It's called the federal funds rate. The Fed funds rate is the very shortest term interest rate there is. It's the interest rate on overnight borrowing. And so, excuse me. And so what we've seen, and you can see the Fed funds rate all the way back to the 1980s. The shaded areas of the graph are recessions. And what we see is that during recessions, so let me just cough real quick. During recessions, the Fed drops interest rates to spur economic growth. And then during good times, when the economy is growing strongly, the Fed will raise rates generally. And so what we see is after the Great Recession, after the financial crisis of 2009, Fed dropped that Fed funds rate all the way down to 0 and kept it there to spur economic growth. And then in the late 2010s, the Fed started to raise that rate as the economy was improving. And then we get hit with the coronavirus. The Fed dropped that rate all the way down to 0. And if you remember what Jerome Powell said 2 years ago, he said, we're not even thinking about raising that rate. They said they're going to keep that rate as low as possible for as long as possible to spur economic growth. Well, in the last year, the Fed has dramatically changed. In just the last 9 months, they really began this, their interest rate increases in March. Since March of last year, the Fed has increased that rate over 4%, the biggest pivot in Federal Reserve history. Now, this is a really complex chart to say that the Fed messed up, right? So one of the things the Fed does is when every other meeting, they meet every 6 weeks, every other meeting, the Fed comes up with a forecast of where they think that Fed funds rate is going to go. And so that's what I've done. I've taken, if you look on the bottom, so you kind of divide it up into years. Here's their forecast for 22, 23, 24, and then their long run forecast. They also call that the neutral rate. The neutral rate is the rate that they estimate neither accelerates or decelerates the economy. And so, and we're going back to June of 21, their expectation, and then September of 21, December, March of 22, June of 22, September and December. And so if we just look at the year 2022, in June of 21, remember the pandemic was already a year in, right? We were already seeing some signs of inflation in June of 21. And the Fed said, we're keeping Fed funds rate at 0 for all of 2022. That was their expectation. By September, they said, okay, we're going to raise that rate one time to 25 basis points. By December, they say, okay, we're going to 1% by the end of 22. Then you see the big pivot happen in March. In March, they say, okay, we think we're going to go to 2%. By June, they say, nope, we're going to 3.5%. And then by September, they said, we're going above 4%, which is where they ended up. So you can just see that dramatic shift in the Fed's expectation of where that rate's going. The next thing you want to look at, we call it the terminal rate. So this is the big debate on Wall Street. When does the Fed stop raising rates? So that terminal rate is where they stop going up. And then the question after that is, when do they start coming down and how far do they go down? The Fed has said, so if you look at this one right here, their terminal rate is north of 5%, right around between 5% and 5.25. So the Fed is going to continue raising rates, or they expect, right? One of the things we've learned is that the Fed has not been very good about anticipating where they need to take those rates. And so in a lot of ways, the Fed has lost credibility with markets and with Wall Street because they were so wrong about where they had to go. But the Fed is saying, we're going to 5%, or we're going north of 5%. Now, what do the markets say? Now, here's one of the interesting things. The markets have generally been better at saying what the Fed is going to do than the Fed has been at saying what the Fed is going to do. So let's look at that. So that terminal rate, the Fed says it's just north of 5%. What do the markets think? So this is the federal funds futures market. They think the Fed is going to top out under 5%. So pretty close, but the markets think that the Fed isn't going to have the fortitude to continue to increase that Fed funds rate above 5%. They also time that terminal rate at June of next year. So there is that kind of coalescence a little bit around that 5%. But there is a lot of debate right now among Fed governors, among the people that actually set these interest rates about where it's going to go. One of them, this one is really interesting. So this is James Bullard. He's one of the governors of the Fed. So he's one of the people that votes on these rates. And I'm not going to get into the technicalities of this chart, but his point in his presentation is that Fed funds rate needs to be closer to 5 to 7% versus where it's been. His point, this analysis of the Taylor rule would say that because inflation is so high, because the economy is running so hot, the Fed is going to have to go even higher than they've anticipated. So you can see kind of this back and forth. This is very rare to have this kind of debate about where that Fed funds rate is going, how high it has to go, when they stop and when they come down. And it's because of, go back to that Jerome Powell quote, because of that uncertainty, because no one knows exactly what to expect right now. One of the struggles the Fed is having. So if you think the Fed has what's called a dual mandate. They're mandated by Congress to focus on two things and just two things, and that's employment and inflation, right? So they're supposed to ignore everything else and look at employment and inflation. Their goal is full employment, that everyone who wants to find a job can find one, but that employers can find employees, and they want inflation to be low and stable. Their specific target is 2%. So if you look at employment, by the way, if you're really bored on Friday morning, turn on CNBC at 6:30. This is when the new numbers come out, and it's like our, monthly Super Bowl. We all get excited, and it comes out, and so we'll get new data for this for December on Friday morning at 6:30. What does this show? It shows that the labor market is still overheating. So we're not seeing an impact. So the goal of the Fed increasing those interest rates is to slow down the economy, is to start creating more room to navigate, and we're just not seeing it, at least in our latest data. If we look at the unemployment rate, going into the pandemic, the unemployment rate was 3.5%, jumped all the way up to 15%, essentially overnight. I mean, that just shows you the magnitude of how destructive the pandemic was. 22 million people lost their jobs in 2 months. The unemployment rate went from 3.5% to 15%. Gross domestic product contracted by 30% in 1 quarter. So we were in complete free fall. What about now, though? We're seeing the opposite problem. That unemployment rate is at 3.7%. That's effectively zero. The biggest struggle right now is the labor shortage. And employers finding the employees that they need. We're starting to hear both regionally and nationally about small businesses not being able to operate because they don't have the employees that they need. So this is our biggest struggle. We need to be around 4.5% to 5% in our unemployment rate, but we're at 3.7%. So this is one of those signs that the labor market is not cooling down. If we look at the labor force participation rate, this is just saying of the total population, how many people are working or looking for a job. So going into the pandemic, that labor participation rate was 63.3%. Right now, 62.1. We've got millions of people that have left the labor force that are sitting on the sidelines and are not coming back in. At least the data is indicating that they're not coming back in. A big portion of these is people that retired early. We have this great resignation of people leaving the labor force, of people retiring, and we just can't get them to come back in, even with tightening financial conditions. And you know, the question right now is, will we be able to get that labor participation back to where it was pre-pandemic, which, by the way, is way down from where it was in March of 2000. It was all the way up at 67%. Theoretically, we should be able to get back to 67, but we just want to get back to 63 again. But this is what's causing this really, really tight labor market. We just don't have access to the employees that we need. Now, the reason that this is such a big problem, though, is this chart right here. This is the one the Fed is really worried about. It's the one I'm going to be watching really closely on Friday. So if you just think about it, when you've got high demand for labor and a very low supply of labor, drives those prices up. And that's what we're seeing with the wage growth. Wage inflation is at 5.1% right now, much higher than our long-term average of around 3%. Now, it's great if you're an employee. You know, it's great if you're getting a 5% raise, and you know, this is the average, so a lot of people are getting more than that. It's really tough on employers. Where are you going to come up with this extra money? How are you going to pay your employees more? And essentially, what the big struggle or the fear is that this high wage growth will turn into what we call a wage price spiral, where higher wages force employers to raise their prices because they've run out of profit margins, and then those higher prices mean that we need higher wages to keep up with that, and it just keeps driving higher and higher. That's what caused our big problems in the 1970s, and the Fed is very concerned about preventing another wage price spiral building into the economy. Then, of course, you know, I mentioned employment, inflation. Inflation has been the big story for the last, most of the last 2 years, and you can really see it. So again, the Fed's target is that red line, 2%, and we've really been right around 2% for 20 years. Inflation really kind of disappeared as an issue for decades, but then in March of 2021, it started to reappear. We started to see that inflation moving up, and it just kept moving up higher and higher and higher, getting up to nearly 10%. I do think that the inflation has peaked, and it's pretty clear. We see some pretty good signs of that inflation coming down. The big debate now, though, is when does it get back to where it needs to be? It has to be at 2%. So the Fed wants to bring it back down to 2%, and we just don't know. We don't know. Another one of the things Jerome Powell said is what we've learned in the last 2 years is that none of us really understands inflation as much as we thought we did. And so this is one of the big questions. So right now we're at 7%, right? 7%, by the way, is 2% higher than that wage inflation. So if you look at real wages aren't even keeping up with inflation. However, that 7%, again, needs to come back down to 2%. One of the fears, and this is one of the things I'm worried about, is I think that inflation is probably going to continue dropping, but then it's going to get sticky right around 4%. And how does the Fed pull that inflation, continue to pull it down closer to 2%? And as they're raising those rates, as they're fighting that inflation, what are the negative economic impacts? It will not be easy, and it could be very uncomfortable to actually get the economy in a place where that inflation is coming down. What about regionally? So while the US is at 7%, our region is at 8.3%. Essentially, what inflation is a result of an overheating economy. And so while the national economy has been really strong, our regional economy has been even stronger, which is driving higher wage growth, which is also driving higher inflation. So we see even more pressure in our region. And then this is the one the Fed is really worried about. So if you think back to the beginning when the inflation first started, if you remember what the Fed said, Jerome Powell was like, don't worry. Anyone remember the word that they used to describe inflation? Transitory, right? So they said, don't worry, it's temporary, transitory, and it's limited. You know, they said it's just used cars and toilet paper. And what they were saying was that it was just goods inflation. But what we see now is it's spread so much that we now see inflation in the service sector. And this is entirely driven by wage growth. So if we see that service sector inflation going up or staying high, it means that that inflation will be even more difficult to bring back down. And while our region has come down a little bit, nationally, we're still higher than the overall rate of inflation in the service sector. Now, so why did this happen? Now, it's easy to look back and criticize the decisions that were made in the past. And the Fed did make mistakes. The Fed called the inflation transitory. One of the other mistakes that was made was the stimulus was too rich. And, you know, again, it's easy to say, you know, you did too much, but put yourself in the mindset of the summer of 2020, when the economy was collapsing. The Fed said, we're going to do everything we can to stop this. So this is looking at what we call the money supply. It's the supply of all the money that exists in the economy. And this is the broadest measure. It's M3. Now, if you think back to the financial crisis of 2009, right, there was the Recovery Act that passed by Congress and signed by President Obama. That bill increased the money supply by about $800 billion. You can see that little blip right there in the middle of the recession of 09. The latest one, they increased the money supply by $6 trillion. So that's what really caused this, this overheating. That's what really caused this inflation. The struggle now is, how do you pull back on that? You know, you can see that money supply is starting to come down a little bit as the Fed is raising rates, as the Fed is destroying demand, and as that inflation is eating away. But we still have this enormous amount of cash rolling around in the country, causing these inflationary pressures. Now, there are some signs that the inflation is starting to come down, but it's very sporadic. This is one of the struggles of Fed policy. Is Fed policy is it's lagged, and it also impacts different parts of the economy in different ways. So we are seeing, if you look here, if you remember the shipping crisis, where we had 100 ships off the coast of Los Angeles, it's essentially fixed. While it was $9,000 to bring a shipping container from China in January of this year, or of 2022, it's now down to $3,000. If you look at the spot price of trucks coming down very quickly, as our demand is contracting, we're seeing those prices coming down. Of course, the big story, those interest rate sensitive parts of the economy are responding very quickly. This is looking at the 1 year change in home prices. I put on there the United States, Utah, and Idaho. Idaho is a really interesting example because Idaho tends to lead the country on the way up, and lead the country on the way down. And that's what we've seen. So you see that big peak in Idaho in October of last year, topping out at around 39% home price appreciation. They're down to 3.1%. Utah topped out at 29%. We're down to 8.6%. And then the US is down to 12.3. You know, as we see that dramatic slowing in home demand that's coming from the big increase in the 30-year mortgage rate. Now, when you look at all this, you might say, well, the inflation is coming down. We're nervous about a recession. Why doesn't the Fed just back down? Or why don't they just change their assumption? This is the reason. The Fed is very concerned about a repeat of the 1970s. And essentially what happened in the 1970s, as inflation started to go up, inflation is in blue, the Fed raised the Fed funds rate or interest rates above that inflation. They triggered a recession in 1970. So they got nervous, they backed down, they lowered those interest rates, and what happened? That inflation heated up again. So the Fed raised rates again, they triggered another recession. So they got nervous and they backed down, and then we got the really bad inflation of the late 1970s. It required the Fed raising interest rates all the way up to the high teens. It triggered two separate recessions. There was financial turmoil in the country, but that's what it took to finally get that inflation under control. We're just starting this process. If the Fed doesn't get that inflation back down to 2%, we could have a repeat of what we saw in the 1970s. So that's why the Fed is going to keep on this and continue to keep, in my opinion, I think the Fed is going to keep those rates higher for a longer period of time until that inflation is solidly back to where it needs to be. Just really quickly looking at kind of our region. One of the interesting things about Utah and Idaho specifically, if you look at our employment growth over the last year, we're actually below the national average now. The US growth rate in jobs is 3.3%. Utah's at 2.6, Idaho's at 3.0. But if you look at it a little differently, if you look at the job growth over the entire pandemic, you see a very different story where the US is barely positive, Utah's at 6.6, Idaho at 6.9%. So essentially what we saw was those states that opened early saw a big surge, and now we're having a little bit of slowing, while other states like California, New York, Hawaii is still down 6.5% compared to before the pandemic in their employment growth. If we look at sectors, almost all sectors are growing right now. The two sectors that are not growing are those interest rate sensitive sectors, financial activities and professional and business services. Specifically, if you dig into the financial activities, it's that real estate sector. And specifically with professional and business services, it's the tech sector. So we're seeing those impacts starting to be felt within industries in our state. If we look at employment by county, you see that we see a big growth or strong growth kind of along the greater Wasatch area, but also in the Una Basin, in Grand County, Summit and Wasatch seeing really big growth. Kind of, they were a little bit later to come in, but we're seeing strong growth in those counties. If we look at the unemployment rate, as of this month, now this is one of our struggles. Remember, I talked about that low unemployment. Utah has the lowest unemployment rate in the country, 2.2%, much lower than the national unemployment rate. And that is making it difficult for the economy to grow. It's making it difficult for businesses to expand, and it's constraining that overall economic growth. If we look at it by county, you see some counties are even tighter labor markets. Look at that, Cache at 2%, Utah County at 2.2, Juab at 2%, little bit higher unemployment in our rural areas, but still relatively very low compared to how we've been historically. One of the real bright spots in our labor market, though, back to that labor force participation. So the one on the bottom is the one that I showed you earlier, the US labor force participation. Look at Utah's. Going into the pandemic, our labor participation was 68%. We're now at 67.9. So we have recovered from the economic impacts of the pandemic. We have brought people back in. Our labor force is much more engaged. We have much more access. So to me, this is one of the real bright spots about the question of how will Utah fare moving forward in this scenario. Kind of putting it all together, again, the biggest question is that economic growth. It is uncertain. We just don't know for sure because we're seeing those continued impacts, whether it's the pandemic, whether it's disruptions in China, the war in Ukraine, continue to create these disruptions that we're dealing with. Because of that, the Fed is going to continue increasing those rates probably until mid-year. I think their rate increases are going to slow. They're going to get close to that 5% that they've been saying. The big question is going to be that the labor market. Will the labor market continue to be tight, or will we start to see some of those impacts broadly in the country? I think that inflation is going to continue to come down, but I'm going to be watching really closely to see when it starts to stall out. And I think it's going to be right around that 4% level by the end of this year, where it's going to get tough for the Fed. And then the bottom line, though, is our region. While we are exposed to that national risk, while we are exposed to some of the struggles of the nation, our region is resilient. Our economic conditions look good. I'd refer you back again to the Great Recession of 2009. That's when Utah emerged as the strongest state in the country. Utah was the best state coming out of the recession because of our unique characteristics. I think we still have those, and I think our state is really well positioned for success in the future. Thanks so much.
Well, thank you, Robert. We appreciate your insights, and we look forward to this upcoming year. It's now our pleasure to introduce a group of insightful panelists who will add some additional insight from their perspective on the economy here in Utah. And let me introduce our three panelists. I'm going to start right here with Janice Ugaki, who is the co-founder and president of FirmSeek, an award-winning strategic marketing and technology company based in Washington, D.C. Over the past 22 years, she has grown the company from an idea to one of the leading website and digital marketing companies in the United States. She has served on a wide range of publicly traded, private, and nonprofit boards. So, Janice, thank you for being with us. Next is Vicki Varela, the managing director of the Utah Office of Tourism in the Utah Governor's Office of Economic Opportunity. She leads Utah's national and international strategy to create a prosperous and responsible visitor economy. Vicki has helped attract millions of additional visitors to Utah through efforts including the wildly successful Mighty 5 campaign. So, Vicki, thank you for being with us. Lastly, Dr. Sydney Shorter. As an entrepreneur, advocate, and champion of diversity, equity, and inclusion, Dr. Shorter is leading Utah's Black Chamber of Commerce and its 400 members into a new era of growth and influence. She has more than 12 years of experience leading, consulting, and training minority and women-led businesses and organizations, most recently as CEO of Execute Now, a finance and accounting firm. Dr. Shorter, thank you for being with us. So I'm just going to throw a couple of questions out to each of these panelists individually, and then maybe one that we will ask each of them to respond to. And we'll start with Janice, if that's okay. Janice, Robert talked about a number of things related to the labor market. And one of the things that we're hearing a bit about more recently are some references to tech layoffs. Janice, are we concerned that this is a new tech winter? And are there opportunities and challenges that maybe are presented with these layoffs?
Thanks, Rob. Can you hear me? I think that's a great question. You know, is this a tech winter? And I think that, you know, There definitely has been a tech slowdown. It's undeniable. But is it a tech winter, a true tech winter, or is it just a few very chilly months? I think that, I voted for option 3. I'm an optimist. There are a lot of tech layoffs right now happening, as Robert very eloquently explained to us, both locally and nationally. But I believe that there are a lot of opportunities that can come from this. When you're in a situation like this, there are the significant opportunities. They come from when, for example, companies really have to then focus and be laser focused on, what makes them successful. Looking at, are they actually providing services and goods that the market truly wants? They have to then look deeper to say, are we being as efficient as possible? Are we actually being as innovative as possible? And then when you're innovating and you see what's working, then you truly have to look a little bit deeper and say, all right, now let's double down on what makes us successful. Personally, my company in 2000, the year 2000, we went through a brutal tech winter. And I think that was a true tech winter. That was when, I think a lot of you may remember, that was when the dot-com bubble burst. I started my company in 1999, and so that was 23 years ago. I was 4 years old at the time.
Exactly.
And it was during those go-go days, the heyday of the dot-com bubble. It was exciting. There was so much capital being thrown around, and VCs and all of that. You had this crazy valuations that companies had that were unrealistic. I think back to that time in 1999, and I think my company was valued, it had an 8-figure valuation. We had no revenue. We had no product, but we had a very fancy PowerPoint that showed that our projections were like a hockey stick. Our revenues were going to go up. And then when that bubble burst and that tech winter hit, I mean, that was a rude awakening. It was like the capital markets dried up overnight. But it was an opportunity. For me and my partners, we had to look at each other and say, what are we going to do? We had to regroup, and then we had to say, all right, we need revenue now. What are the services and goods that we can provide now to make revenue? And then we looked at each other and said, we also have to find market areas for growth that have long-term growth. Luckily, we found that niche. We were very flexible. We had to be very innovative. So I believe that, a tech winter or even chilly months can truly be followed by a tech spring where there are a lot of opportunities.
Wonderful. Thank you, Janice. Vicki, as Robert pointed out, one of the great strengths of Utah's economy is the diversity of our economy, but one of the drivers continues to be the tourism and what you and your team help drive in our state. We hear a lot about China. What impact are we seeing in tourism from China's travel restrictions, and what's your outlook for the tourism industry in Utah in 2023?
So China, I think I would go to Robert Spendlove's overview. Economists just don't know. And I would say we just don't know where things are headed with China because they lifted restrictions so suddenly, and now there's all these boomerang problems, presumably understating deaths from COVID quite significantly. So it is going to take some time for the China market to settle. The fact that we've had so many constraints in international visitation, not just because of China and COVID, but because of the strong dollar, the weak euro. This impacts our industry significantly. As a whole, we have come out of COVID quite well. The most important thing for us, I think, referencing some of Janice's comments, is that in these puzzling times, it's critical to double down on strategy, to play to your differentiating strengths, to ensure that you're thinking not just quarter to quarter, but long-term play about what we want the Utah visitor economy to be, what we want the Utah economy to be. And we are guided at the Office of Tourism by the Red Emerald Strategic Plan. Some of you may know that there is a rare stone mined only in Utah called the Red Emerald. We call it the Red Emerald Plan because that's what we want the Utah visitor economy to be. Something different, something highly valued, something that people are willing to invest in, both the hosting communities and the visitors, so that it is a quality product over the long term. So this means we're not in the volume game. We're in the business of building out the areas of the state that want to expand their visitor economies, being really good stewards over areas like Moab, who say, actually, we think we've had enough. We just want to improve the quality of the experience for us as hosting Moabites and for the people who visit here. And so as challenging as these times are, I would agree with Janice that they're full of opportunities to come out of it even stronger than we are today.
Wonderful. Thank you. Dr. Shorter, we heard Robert talk about the business climate here in Utah. Interested in what trends you're seeing among the businesses in your chamber, and also, are there new prospects for access to capital and greater economic inclusion that you're seeing?
Thank you for that question, and thank you for the opportunity to be here and with this distinguished panel. I picked number 2 because we don't often have an opportunity to be proactive. And so number 2, if we're forecasting to what may happen over the next 12 months, this gives us an opportunity to use some historical data, but also be proactive. We've experienced the Fed's overshooting, but we have been a bit resilient as it relates to business. We talked about and highlighted the Great Resignation, but one of the things we didn't really see a decrease, we talked about this earlier, we didn't really see this huge impact except when COVID hit and we had the 22 million unemployed, but we recovered pretty quickly. But right after that, we go into this time of the Great Resignation. Well, if they're resigning, then we should see unemployment if there is this impact to labor. But what I see is happening is what I call the Great Transformation. Right now in Black businesses in the Black community, we are the fastest growing culture in entrepreneurship, even at the risk of not having affordable capital. It's the lesser of two evils, but I also say that that is an indicator to industries and corporations to really be cognizant of why you're losing the best and brightest who are stepping out at great risk to do it on their own and still perform. And so I still lean on this is an opportunity. And it's not just about sustainability. We have to actually look at it from a perspective of how do we withstand? How do we withstand, not just sustain? And so when we look around and look at the landscape of access to affordable capital, investment in Black and brown businesses, we do see an increasing number of even BIPOC VC organizations and entities. Now, the dollars that are invested are about 1/3 of what you see from the totality. But we are still building and growing and optimistic because what the real goal is to ensure that all businesses are a vital part of the economic ecosystem. That's really the goal.
Absolutely. Thank you. Let me throw this question out. I'll just make this the final question. You can each take 30 to 60 seconds to respond. Even you, Robert, we've heard a lot from you, but I'm interested in your thoughts on this as well. As we've now sort of come out of COVID, for the most part, how have the disruptions from the COVID-19 pandemic shifted our economic environment or your specific industries? And are they temporary, or are those changes here to stay? Robert, you want to start, and then we'll maybe work our way back?
Yeah, and I think so. I'll give the ivory tower answer, and you guys can talk about what's really happening. The big question in my mind is those retirees. I'm going back to that labor force participation, and I think, what would it take to bring them back in? Bring them back in the labor force. You're essentially saying, how do you force someone to come out of retirement? It's really tough, and you have to make them really uncomfortable. And I'm not sure if we're willing to do that, because they're also the people that are most likely to vote. So if this is not permanent, then we need to bring people out of retirement. And number two, we need to bring more people into this country. We've got to have a better international migration system. We've got to bring these workers in. They want to be here, and we need them. And so those are the biggest struggles that we have right now. But I think this is a new normal. I think at least it depends on how you define long term, but at least in the intermediate term, this is our struggle unless we're able to address those big long term problems.
Great.
Yeah, thank you for that high level picture, because that is truly a reality. I think really the focus is on two things, and that's policies and strategies. But policies and strategies, because when we talk about, I saw someone really shake their head really hard when you mentioned bringing people out of retirement, because you understand, we buy our way into retirement. We bought our way there, and if we're on a trajectory that people have to come out of retirement, we're doing our economy a disservice to a certain degree. And so between the policies and the strategies, ensuring that we don't land there, but I'll go back to my word of understanding, what is it can we withstand?
So I just want to amplify what Robert has said about immigration. I'm calling for a back to the future immigration policy where the United States shows the kind of leadership that made this country great, by rethinking everything we do related to immigration and making the entrepreneurial, tenacious, innovative people from all over the world that want to be part of the American experience, enabling them to do that. It's not just H-2B policy, it's not just J-1 policy, it's rethinking the whole thing to make us international leaders in immigration. And if there's a place in the country that can lead on this, it's Utah. Where so many languages are spoken, where there's so much generosity toward new people and new ideas. And I just cannot say enough about the opportunities, the positive disruption that could come from that kind of leadership.
Vicki, I'm from the South. Can I say amen? Okay.
I think from the pandemic, I'm sure all of us started to have Zoom fatigue, where you would see, all of your meetings were on Zoom. I think that was also an insight into the world of our workers, not only in the tech industry, but across the nation, where you saw a lot of women who had young kids, and you saw the kids climbing into the frame or on their laps, and they were trying to multitask and do so many things at one time. I think one area that in my company, as well as other companies that I know, they've had a hard time getting women who are phenomenally qualified to be able to come back. Even though school has started again and they're in in-person school, they started to realize, wow, this is very difficult to balance. So I think that that's an area when we were talking about policy strategy, maybe getting the retirees back, but also really trying to support people who are caring for aging parents, who are caring for young children, but having that type of a flexible workplace. I'm really hoping that that's something that that we can really build upon, not only as a state, but as a nation.
Wonderful. Well, please join me in thanking our panelists and Robert Spendlove for this economic insight. And thank you to each of you for joining us this afternoon. We appreciate you. Thank you for being with us. And also thank you for choosing to do business with Zions Bank. We appreciate you and look forward to celebrating this, our 150th year with all of you. Thank you so much and enjoy the rest of your day.